Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with Martin North. How are you today, Martin?
Pretty good, although it's still skinny. We've got a technical issue which we can't quite iron out, but never mind. I'm still here.
That's all right. It doesn't affect the slides at all. So it's been a big month in Australia. A lot has been spoken about in terms of a sharp housing recovery and also monetary policy. So we are going to get through all those slides today, aren't we?
Yeah, indeed. And I think we have to start with monetary policy, right? Because essentially the critical issue to understand is that the numbers coming out of the economy are quite weak. And there's a disparity now between essentially what the Treasury was expecting and what the RBA was expecting and what we're seeing. And on Monday, we get the MYEFO, which is effectively the mid-term update, and it'll be interesting to see whether they down forecast employment or down forecast the GDP growth, or whether they hang with it, right? And if you look at the GDP numbers, on that first slide, you'll see that it was as slow as right. Basically, living standards grew by 0.2% over the month. The GDP was pretty low. Company profits are still up quite high, but the household sector is really, really under the gun. They're not spending. What they are spending, they're spending not on discretionary items, but on necessities. And really, the only beacon of hope, well, there are probably two beacons of hope. The first is the housing sector, and the second is the iron ore price, because the iron ore price has now gone up by $10 over the last little while. And for every $10 the iron ore price goes up, we get an extra 3.7 billion coming into the accounts, right? So essentially, you could argue that the reason that the accounts are reasonably good is simply because the iron ore price has been quite high. It's been up to 120, dropped to 80, it's about back up to 90. And the other lever, which is the one, of course, that the Reserve Bank and the Treasury are going with, is to try and encourage people to feel more wealthy as home prices rise and as perhaps home price transactions increase, because that's really the only game in town. We're not seeing growth in employment in absolute terms. I mean, there are more jobs, but those jobs are tending to be low-paid jobs. They're tending to be jobs, for example, in healthcare. We know that the CPI is still probably understating the reality in terms of households. So a lot of households are really feeling it. So it really comes back to what extent is the RBA right in betting on housing, which is, I guess, where we're going to take the conversation from here.
Yeah, and just that statistic about company profits up 12.7%, over the year. That really is amazing when you consider that people aren't getting any wage growth. It's just the guys at the top, once again, driving the inequality.
Well, it's really fascinating that essentially, yes, the results from the last time around weren't bad. By the way, the revenue from to shareholders from the banking sector is down, and we'll probably see more of that. But nevertheless, overall, corporates are doing pretty well. In fact, they're doing very well. And if you think about how they're doing that, they're not doing it by raising prices because there isn't much upside there. But what they are doing is squeezing costs. And one of the things that they can do to squeeze costs is to maintain pressure on wages growth. And so the wages growth has a two in front of it, and probably, if we see that continuing, that's a good outcome. It's not a good enough outcome. But yeah, there is a disparity. The other point to make is that if you look at the mix of tax being paid by corporates relative to individuals for income tax, corporate tax is going down, right? So effectively, more and more of the tax burden is being taken by the tax creep and everything else. Despite the tax refunds and other things we've seen, households are essentially paying more and more into the exchequer, effectively, to keep the economy going. So there's something wrong here at the heart of the way our economy is set, I think.
Yeah, and companies are probably more active in managing their finances. When we have 3 rate cuts, they're going to roll over their debt and their payments are probably going to go down, whereas households, well, what we've seen is they keep paying the same amount on their mortgage, and a lot of them aren't active about getting a better deal.
Well, you're right. And it's very interesting if you look at what happened. So we had the tax cuts and we had the interest rate cuts, right? And as you say, households are still paying pretty much the same on average on their mortgages. In other words, they're paying down their debt faster, which is why essentially the growth in credit is very low, and we'll touch on that in a second. The other thing to note is that where people did get tax refunds, they didn't spend it, they've saved it. And the reason they've saved it is because they're not feeling very confident about what's going on. So, this whole sort of scenario up towards Christmas suggests that it's going to be quite a tight Christmas for many households. And, the economic outlook, and therefore the MyEFO projections, will be really interesting to see. Will they hang in with their surplus? I think they will. They've almost locked that in as the number one objective of the government. But in terms of households and what it's really like on the ground, it's still pretty tough.
For sure. Well, the next slide, Martin, is all about that household debt, and we've seen really bad figures out of retail, and yet household debt remains high.
Yeah, so this is the international benchmark from the BIS, right? So it essentially gives a bit of a read as to where we stand relative to other countries. And so the first one is household debt to GDP. And we're number 2. So Switzerland is number 1 at 130.9. Australia's 119.3, and then we go down. New Zealand's 94, the UK is 84, the United States 75. This just underscores how much debt we have in the system. Now, if you think about what the strategy is to try and encourage people to borrow more, take more mortgages, take more debt, because if they get more debt, then they're going to spend more. We're already right at that sort of ceiling, and so the question is there any more capacity in the upside to increase the debt further? And this statistic would say there's very little. And by the way, there are some anomalies with the Swiss data. So effectively, I would say we're pretty much at the top of the pack when it comes to the debt to GDP.
I was going to say, what are the similarities and differences to the Swiss economy there?
Yeah, so of course, Swiss is a very big international financial economy, and so there's a whole bunch of other stuff going on. As a result of that, their GDP is somewhat lower than you might expect, because effectively GDP measures economic activity, right? So my point would be that the economic activity and the economic fundamentals in Switzerland are rather different from ours. Our GDP is actually being flattered by the high iron ore price, for example. So you could argue that probably the debt to GDP is probably worse than this,
Awesome. Okay, so Australians win on the debt servicing ratios. So as we said, at the moment, people are paying more than they have to, but to trying to pay down that debt.
Yeah, so this is the other one from the BIS. Again, this is very fresh data. So they measure the debt servicing ratio. So basically, it's what is the proportion of income that's going on to service debt? And we win. We're the highest in the world, 15.6 relative to Canada at 13.3, United Kingdom 8.9, United States at 7.8. So this just, again, underscores we have a massive amount of debt in the system. We have significant issues with households servicing that debt. And with incomes flat, cost of living rising, it's not surprising that people are finding it difficult. And we're right at the top. So again, I question, to what extent is there more capacity in the system for households to borrow and service yet more?
Do those figures take into account the shadow finance system? And if I've got afterpay debts and all that sort of thing, is that picked up in these figures? Or
so it tries to look at total debt of households as reported in the official statistics. Now, it might be a little bit noisy, but yeah, it tries to cover pretty much all of the mechanisms that people borrow against.
Yeah. Next up, we've got credit growth, which is still slowing.
Yeah. So, of course, this is the anomaly, right? So, the question is, if house prices are rising, as many are thinking they are, and yet people aren't borrowing more, how is that possible? Because basically there is a strong correlation, as we've discussed on previous shows, between credit growth and the rate of credit growth change and home prices. But nevertheless, the RBA stats that came out at the end of last month for October shows that we're now at 3% annualized, right? And that's the lowest forever in terms of household borrowing for mortgages. And within that, owner-occupied housing growth is at 4.8. So that's moving quite sharply. But investor is still way down. In fact, it's minus 0.2. Personal credit's still falling. And of course, the other worry is there that business credit is also pretty low as well at 2.7. So we have a economy where effectively the growth in credit is very, very slow. And that, again, I think reflects the pressures that we see in the economy. Now, the other observation here is we don't have the monthly flow data from the ABS. We would normally have that by now. But because they're recasting their figures, we won't know for another week or so what the new flow data for October was. So we can only impute what's going on from looking at the total balances. And I think probably what we're going to see is that we've got more people paying down debt, as we discussed a little while ago. And I expect to see a slight uptick in new credit, mostly for owner-occupiers and mostly for refinance. Very little, I think, for investors. But I do expect first-time buyers to be quite active still, and so that we'll see some loan growth there. But we'll have to wait for a little bit longer before we get that data.
So the sharp uptick we've seen, we think it is those home owners that are coming back into the market that were waiting to buy, and they're buying the dip.
Yeah, so I think there are a few things going on. First-time buyers are a little more active than they were. We're certainly seeing that. We also know that there's been quite a lot of refinancing. In some cases, when people refinance, they do actually pull down more equity out of their property to pay off other debts, for example. So we think that's there. And then there is also some activity, people trading up in the market. So as you say, buying the dip, thinking, well, maybe not a bad time from an owner-occupied point of view to trade up. Still seeing very little activity from the investment community. So property investors from my surveys are still saying, well, we're seeing rentals very low, no growth in rentals. We're seeing a lot of pressure in terms of servicing investment mortgages. We've still got the interest-only switch going on at the moment. So that I think all of that is keeping a bit of a dampener on investor mortgages. So it's really owner-occupied land. And I think we're going to see this continuing. I think the spate of refinancing may be easing now because I'm not sure we're going to see any more cuts in mortgage rates ahead. So then it's a question of, well, who's going to be buying into next year? Is it going to be first-time buyers? Well, of course, we know there's 10,000 government-supported loans available now from 1 January, so a bit of a race for those probably. We know the banks now, 27 banks have been listed to actually provide those loans. We know that some people are still thinking of trading up. But my concern is that there could be a bit of a rise in prices, but the question is, how sustainable is it given the broader economic parameters that we discussed earlier?
Yeah, and the apartments is the other thing we should probably mention, where that was a very attractive segment for those investors, and that is just not the case anymore.
Well, we've still got the issues with poor quality construction. We've got a broadening in terms of the classification of cladding, which is now classed as flammable. So they started with the particular ones that were known about, but they've now extended into some of the engineered timber construction cladding as well. So we've got more and more properties across Australia who have defects. And, again, my surveys show that a lot of prospective purchasers are steering away from new high-rise and relatively completed high-rise because of the unknown unknowns with regard to the quality of construction and particularly the flammable cladding. And I think that's going to continue to put a dampener on that sector of the market. The other point, of course, is that if people are able to buy closer in and still get a house, they would prefer to do that relative to a unit. And because of some of the price falls that we've seen, houses in some areas are a little more attractive than they were. So I think that dynamic will continue. And certainly I see a lot of people who are in existing units remain concerned about the quality of the construction. And they're worried about, should I say anything about the cracks I'm seeing? Or should I just keep quiet and hope that it doesn't actually have a negative impact on prices? So this is going to be an ongoing and a big issue.
Yeah, definitely in the headlines for 2020, I think.
Oh, yes.
So non-performing mortgages by state.
Yeah, so this is quite interesting. So APRA came out with a piece of announcement earlier in the week to say that they're not going to change the zero baseline for what's called the counter-cyclical buffer. So the idea is if the economy is in difficulty, then you will probably want to lift the buffer. In other words, make the banks hold more capital, because essentially that will protect the banking system during a series of stress. But they've came out and said, no, there's no issues, right? And they basically went through a whole bunch of parameters saying, well, prices are rising and credit growth is looking pretty good, et cetera, et cetera. And they said, well, actually, even non-performing mortgages is not bad. But actually, when you read it, what they said was about half of the rise in arrears is in Western Australia, where it's sitting at around 2%, right? Arrears are also rising steadily in Queensland and South Australia. And over recent years, arrears have also been rising in New South Wales and Victoria, even from a low base. So, I get the feeling that they're actually understating the non-performing mortgages that we've actually got in the system. And of course, this is once the door is shut. So these are the ones that are actually gone into default effectively. And, it's the narrowest view of the risk in the system. So APRA has basically said, yeah, risks are rising, though they're still relatively low. So my view is APRA is being, I think, quite aggressive in their view of the economy, and particularly in the view of the banking system. And when you actually read through the rationale for their counter-cyclical buffer assessment, they said, there's a few things there, but they also warned that ahead, it's likely that they would increase the buffer. In other words, they've got more concerns ahead. So something doesn't quite add up.
Yeah, absolutely. And I think if we get that ramp up in housing prices, what APRA are going to do, and that relationship between the RBA, the government, and APRA, again, that is going to be so interesting to watch play out next year.
Well, of course, they all sit around the table in this thing called the Council of Financial Regulators, right? So the Treasury, APRA, RBA, ASIC, and a few other hangers-on, including Austrac. That's where sort of policy decisions are sort of set, I think. But, if you bank on the housing sector as being essentially the lever for growth, which is what everyone is banking on, sitting around that table, and yet the data that's coming out is saying something different, then you've got to question whether this is actually going to work, I think.
Yeah. All right. So business and consumer confidence still trickling lower.
Yeah, so this is the latest data from the Westpac and the NAB survey, and then Westpac and Melbourne Institute. Unfortunately, both business and consumer confidence continues to ebb away. And you can sort of understand why, because essentially businesses are finding it really tough to sell stuff because consumers aren't buying. We also know that many businesses are seeing their terms of trade extending, so effectively they're having to wait longer to get paid, so they've got cash flow issues. And then on the consumer side, basically sentiment is just falling away because of the broader economic issues. The only bright spot, according to the Westpac survey, is there is a bit more of an intention prospectively to purchase next year houses, but it's relatively a small uplift, and it's still quite low relative to where it was previously. And my own surveys say, well, there are people potentially contemplating it, but of course, then the question is, well, will they go through with it? So, generally, I think we're in an environment of low positivity for both businesses and consumers, and that's going to have a further negative effect, a feedback loop, if you like, on the broader economy.
Yeah, and that rolls into your next slides about household confidence and mortgage stress continuing to tick higher, which is maybe a bit of a surprise.
Yeah, so, the data from our surveys underscores that same issue. Household confidence is low, and in fact, all household segments, including those who have no mortgages, are still below the long-term average run. Property investors are actually pretty under pressure as well, and even those who are renting, their finances are under pressure. So basically, the index is as low as it's ever been, which is worrying. So, I'm just reflecting what other surveys are showing. But on the mortgage stress side, you'd have thought, would you not, that with rates dropping, and with the tax refunds and the other things that have happened, interest rates lower, you would expect to see some betterment in terms of the amount of stress in the system. But we're not seeing that. What we're seeing is it went sideways for a couple of months, but now it's up now to the highest. It's been 32.5, which is well over 1 million households in stress. And when you actually drill down into it, right, there are a few drivers. The first is that still a lot of people who are actually struggling with power bills, and in fact, disconnections are higher now than they've been for a long time. And there's a post on the DFA blog where we've gone into that in some detail, because we think proper electricity disconnections is a really quite important leading indicator. We also know that the cost of living are rising. Some of those relate to the drought, so some food staples are actually rising. And we know. And then the other factor which is there as well is that on the income side, less households are working the hours they want to work. So in real terms, take-home pay is actually not going forwards, it's going backwards. Overtime is lower. The number of hours that people are able to work is lower. So net income's coming in is lower. And in fact, the data from the ABS that came out quite recently also confirmed very little income growth. So we have flat incomes, we have rising costs, childcare costs rising, all those things. So net, the mortgage is still a big noose around many households' necks, and therefore mortgage stress continues to rise. And that's a predictor, maybe 18 months, 2 years ahead of potential high levels of defaults. So this is one to watch, I think.
Yeah, I think underemployment is something that's just not reported enough in America and in Australia. And the other thing is probably healthcare. We've seen a lot of people, particularly younger people, dropping out of private health insurance and just trying to save those costs here and there.
Well, that's right. Yeah. So it's absolutely right that people are hunkering down and, making some hard decisions about what not to spend money on. And what's fascinating in the surveys is that people are still spending big on digital connectivity. So they're still paying more for mobile phone plans and those sorts of things. So that's the one area that's sacrosanct. But other areas across the board, people are still hunkering down.
Absolutely. Yeah, I'll probably just mention quickly, Martin, that I know a lot of friends that we've got to the point now with the mobile phone plans and whatnot that the iPhone 10 is not that much better than the 8 or whatnot. And a lot of people are paying $100 a month. And you say to them, well, did you know you can get $50 a month or just get prepaid? A lot of these plans now have unlimited data and messaging and whatnot. And you've already got a good phone. And so people are starting to say, well, yeah, that's another $50 a month I can save.
Well, that's right. It's very interesting to see some of that happening. And people are actually, I think, still allured by the latest tech, and want the flashiest phone. But actually, the delta in terms of functionality you get these days is much lower than what it was. And I've got one that's 2 or 3 years old, perfectly happy with it, works fine. No chance I'm gonna change.
I might buy one for Christmas, Martin. So housing turnover is still well down, and this is definitely something that's been spoken about a lot by you guys and in the mainstream about those reported figures.
Yeah, and this is really important, right? So people may be getting the feeling that the property market is, back to quote normal and prices are rising, et cetera, et cetera. But the number of transactions are significant. And this actually comes from APRA via CoreLogic. And, it's one of the indicators that they again quoted as why there should be no change to the counter-cyclical buffer. But look at the transaction volumes. They are, they've dropped by 20% relative to where they were, let's say in 2002, then, it was 40% difference. So yeah, total transaction volumes are significantly down. And that means that less people are buying and selling property than previously. And the other interesting thing is that if you look at listings, they're also down too. And in fact, over the last quarter, I expected listings to be a little bit higher because I thought people would probably come back into the market. But in fact, listings stayed low. So we have low listings, we have low transaction volumes. And in a way, that's probably the key to try and understand why we've got some of the housing price data that we've got. Because essentially, if you have low supply and if you have essentially, people wanting to buy, then they may, in some places, pay over the odds. But that doesn't necessarily mean that the property market is back to normal. And I keep saying these low transaction and these low turnover figures suggest to me that we're still running on empty when it comes to the housing sector.
Yeah, low liquidity is the same in every market, the way it works there. So home prices are still up. We've spoken about this a little bit. It's been one of the sharpest increases in a number of years. We've kind of touched on why that might be already, Martin, but any other thoughts?
Yeah, so this is the ABS data. So this is, of course, they draw on the CoreLogic data. And again, using the chart on the right-hand side, that's the APRA data. So they annualized the 3-month rates from the ABS and CoreLogic and said, oh, look, it's, more than 20% rising in Sydney and Melbourne. I mean, yeah, that's one way of looking at it, but is it the right way to look at it, right? That's the key question. If you look over the last year, prices are still down below their peak. So we're still not back to where we were, right? But yeah, everybody focuses on, these movements, these recent movements. And if you look at the next slide, this is where you start looking at, well, actually, it depends on how you look at it. So, for example, if you look at CoreLogic's view, then, yeah, the movements over the last quarter have been very strong. If you look at the ABS, not quite so strong. If you look at SQM, who looks at asking prices, not settlement prices, you get a different answer again. But all of those three are using algorithms to essentially try and impose on the whole market what they're seeing, right? So there's a disconnect, if you like, between that and real settlements. And the only one, well, there's two, REA and Price Finder. So REA is realestate.com.au, which we've spoken about before, which said in Sydney 0.8% over the last quarter. And Price Finder, which is the domain data set, is still on settled transactions reporting drops in prices on settlements. So this is the price of real settlements that have actually been made over the last quarter. So we've got this amazing contradiction which says, so to what extent are home prices really rising? Are they rising across the board? Are they rising in some suburbs and not other suburbs? And I think the truth is there are definitely positive movements in some suburbs, but in other suburbs, there's no real improvement. And so some of these other indices may be flattering what's really going on. So I just say to people, be a little bit cautious, right? Go granular. Look at the data locally. Don't go with these high level, it's all wonderful, 6.2% in Sydney, right? That may not be the full story. So all I'm just warning is just people should be a little bit cautious and, look at real settlement data in that local postcode, because I still see quite a few postcodes where true settlements are still lower than they were 6 months ago. And so maybe there's a bit of mythology around what's really happening with home prices.
And that was something that we were going to watch as it came into that spring and the popular time of market, and it has been a little bit lower than what a lot of people were hoping for.
Yeah, exactly. And going back to what we said about what APRA did, can you really annualize those 3 months, even if it's true, and say, well, that means it's more than 20%? No, of course you can't. I mean, it's done for effect, right? So we need to get some reality in the numbers here. All I'm saying to people is be really cautious about those high-level headline numbers, because they're masking what's really going on down on the ground at individual postcode levels, at individual types of property levels. And, I'm still seeing many postcodes where prices are down 15, 20% from where they were. And remember what I said, they're still lower than their previous peak. So we've still got ground to make up. And APRA did make the point that around 20% of properties across the country are still underwater from where they were previously. So we've still got many properties that are actually in negative equity or underwater from where they bought. And that's a very significant factor, I think, still in the market that people need to be aware of. Yeah,
you would never see an investment fund come out and say that if they'd been in a bear market and then we had a 10% bounce and they come out and say, well, annualized, we're now projecting 120% growth for our fund for the year. It just doesn't make sense to do it that way.
Well, you'd have to get a disclosure to say, there's no prediction of what happened in the past for the future, right? But we don't get that with home prices. We just get this massive mainstream splurge saying it's all wonderful, go sell, go buy, and it all goes back to what I said at the start. People are betting on the housing sector as effectively the lever to save the economy, and I just wonder whether we're being over optimistic.
Yeah, I tend to agree. So finally, auction clearance rates. And I'm a bit surprised, Martin. I actually saw an auction in Tasmania the other day, and I think it got sold. So that would have been 100% clearance rate.
And that's really the point, right? So we need to be a little bit cautious about auction clearance rates as well. Remember that those are self-reported, firstly, right? Remember that the volumes are very low, right? And so, for example, on this chart, I ran a quick calculation based on what Domain claimed the reported clearance rates were, so 78.6% in Sydney, and what the data that they actually had showed, which was at 57.4%, right? So there is a disparity between the raw data and what the various agencies are reporting in terms of clearance rates. And I had an interesting chat this last week with some guys at Fresh Canvas who actually have gone through and analysed in detail all of the auction data, so the data coming in and then what's reported. And basically their conclusion is more like mine, that essentially the real true clearance rates are considerably lower. And there's a few reasons. Firstly, if you're a real estate agent, you're much more likely to report positive news rather than negative news. So the ones that are never reported and aren't in the statistics, right, are always not taken to auction and not sold. Second, you'll quite often see property then coming back on the market still for sale. And third, this isn't just a spot day. Most of the reporting is done over the week. So, for example, CoreLogic says it's over the week, as does Domain. And we know actually that in some cases it's information from 2 or 3 or 4 weeks. So there's a whole bunch of be careful about auction clearance rates, because they're as much fiction as fact, in my view. And if people want to hear more about that, they can go and look at the thing on the DFA channel, where we've actually said through the truth and lies of auction clearance rate. We've gone into some detail. So again, I just caution, just be a little bit careful about these auction clearance rates and about all of the mainstream splurge again about, it's all wonderful, right? No, there's a lot more reality that people should get to. And again, go granular, go local. In many cases, very low auction numbers mean, you get very high rates. There is lots of other stuff going on. And in some suburbs, we know that almost no auctions are successful. So again, I think it's a matter of being, more discriminating than just the high level mainstream media story.
Yeah, as I said before, Martin, maybe they'll start to include the Tasmania statistics if they start to be pretty positive, even on a low number of 1 or 2 sales.
Well, exactly. Well, 100%. Great. Whoopee. Exactly. And by the way, Tasmania is doing quite well relative to the other states, although actually the price growth is easing in Tassie at the moment. So it'll be interesting to watch that ahead as well.
Absolutely. Well, I think that wraps up. And I was going to say, Martin, it's our 1-year anniversary since we started doing this, which is pretty cool. So, yeah, thanks for helping us out. I know everyone loves this episode, and we might have to do a bit of a wrap up of the year and a look ahead sometime this month or early next year, because I don't think there's a lot of data out in the next few weeks, is there?
Well, there's be a little bit of a hiatus over Christmas. Yeah, very happy to talk about that. And I've really enjoyed working with you over the last year, Alex. And I think we've hopefully contributed to helping people understand what's really going on.
Absolutely. So have a good Christmas and New Year, guys. And I mean, Martin, it's pretty amazing if you look at the number of subscribers on both our channels to have this many Australians interested in these things. It is really awesome.
It is awesome, and it's very important. I'm glad that people are actually finding out some of the truth of what's really going on.
Awesome. Thanks, guys. Have a good Christmas.
Cheers.